Welcome back to Geoscope, your source for global power plays. Today we're unpacking how a quiet trade spat in early 2025 shifted into a geopolitical showdown. The US slapped a 39% tariff on 1 kilogram and 1 ounce Swiss gold bars, driving futures to a record $3,534 per ounce. Switzerland, refining about 70% of the world's gold and exporting $36 billion in bullion in just the first quarter, pushed back hard. Swiss President Karin Keller-Sutter made a last-minute appeal in Washington, but markets only calmed when President Trump abruptly canceled the tariff on social media, sending prices back to $3,407. This fight isn't just about gold prices. It could reshape reserves, trade flows, and the balance of global monetary power. The second Trump administration began its term with a renewed focus on its America First trade doctrine. By the spring of 2025, its attention had settled on an unlikely target, Switzerland. Citing a persistent trade deficit, the White House prepared a move that sent shockwaves through global finance. In April, it unveiled one of the steepest tariffs ever imposed on a developed nation, a punitive 39% levy on most Swiss imports, from pharmaceuticals to luxury watches. Initially, the financial world breathed a sigh of relief. Gold, the bedrock of global finance, was widely expected to be exempt. The U.S. Federal Reserve itself depends on Swiss expertise for its reserve management. But inside the administration, trade hawks saw a unique point of leverage. They framed it as a strategic test of Bern's dependence on American markets, betting that the threat alone would force concessions on other trade fronts. It was a high-stakes gamble, using the stability of the gold market as a bargaining chip. Switzerland's dominance in the precious metals industry is difficult to overstate. Its high-tech refineries like Valcambi and Pamp are the world's gold standard, processing an estimated 70% of the globe's raw gold each year. They transform metal from mines and recycled sources into the universally trusted LBMA-approved Good Delivery bars. These bars are the physical backbone of the entire financial system, shipped to central bank vaults and financial hubs from New York to Shanghai. For decades, the U.S. Federal Reserve has relied on these very refineries not just to source new gold, but to maintain the vast American reserves at Fort Knox and West Point, reassaying and recasting older bars to meet modern purity and trading standards. After months of tense, behind-the-scenes diplomacy and intense lobbying from the financial sector, the conflict reached its peak. The ambiguity over gold's status was a weapon in itself, creating market paralysis. Then, on July 31st, the hammer fell. U.S. Customs issued a formal ruling, COMEX standard 100-ounce in kilobars. The very instruments traded on U.S. exchanges would face the full 39% tariff. The reaction was immediate and chaotic. Gold futures surged to decade highs as the cost to deliver physical metal in New York became untenable. A last-ditch trip to Washington by Swiss Finance Minister Karin Keller-Sutter failed to secure a compromise. The fuse was lit. But this was never just about gold. Behind the scenes, a confluence of deeper tensions had finally boiled over. There was the administration's relentless focus on the $48 billion trade deficit, primarily driven by Swiss pharmaceuticals. There was a powerful campaign from Utah's mining industry for supply chain transparency, accusing Swiss refiners of obscuring gold's true origins. And woven through it all was the decades-old American frustration with Switzerland's staunch banking secrecy, a symbol of a system Washington had long sought to dismantle. The gold tariff was simply the weapon they chose to fight these other wars. Gold may carry ancient appeal, but modern refining is a high-tech craft, and Switzerland dominates it like a championship pit crew. Its 4 major refineries produce bars pure enough to meet the strict standards of central banks, including the Fed. Rivals like Canada and Australia lack the same scale or consistency, while Japan faces heavy domestic demand and logistical hurdles. Even if they expanded, factors such as LBMA certification, higher insurance, and slower delivery would keep Swiss supply nearly irreplaceable. And Swiss bullion is tied to other precision industries, watchmaking, pharmaceuticals, and catalysts. In early 2025, gold accounted for 2/3 of Switzerland's U.S. trade surplus, a major reason Washington's tariff shook markets far beyond bullion desks. On paper, An $80 million boost from a 1.2% levy, or even billions from a 39% tariff, looks small next to a $48 billion trade deficit. But gold is no ordinary import. Its price influences Fed reserves, liquidity buffers, bond yields, and the dollar index. A $15 jump in premiums can lift yields by 15-20 basis points, strengthening the dollar but hurting exporters, a paradox for Trump's deficit agenda. Politics added friction. Utah miners demanded strict origin rules, while jewelers in New Jersey and Illinois lobbied for exemptions. A few Senate votes could decide the outcome. Banks issued warnings. UBS said prolonged premiums could buoy the Swiss franc, while JP Morgan predicted the Fed might inject up to $75 billion into repo markets to stabilize rates, a costly move at odds with Trump's fiscal goals. Byrne has broadened the fight, linking gold tariffs to other prized exports, pharmaceuticals, luxury watches, precision tools. Swiss negotiators hinted that any gold relief might require U.S. concessions on quotas for drugs or duties on industrial parts. But one area remains untouchable: banking secrecy, protected by Swiss law and public opinion. Debates at home focus on how to use potential tariff revenue. Conservatives favor protecting industry, while the left leans toward climate and social projects. Yet there's unity on one point: no U.S. exemption without meaningful gains. Switzerland's refining clout, handling 2/3 of global bullion, ensures its bargaining position remains formidable. As negotiators convene, the air is thick with unspoken urgency. Both sides understand the cost of letting this drag on. In our interconnected economy, the ripple effects would be felt far and wide. With pressure mounting from domestic industries, a stalemate isn't just a political failure, it's an economic time bomb. For Washington, the stakes are deceptively high. Tariffs risk locking in higher gold premiums for American consumers. More critically, by weaponizing trade policy, the U.S. could spook international creditors, raising its own borrowing costs. This also chips away at the credibility of the U.S. dollar as the world's primary reserve currency. For Byrne, the view is equally fraught. The U.S. is a critical market, and losing preferential access could slash export revenues by billions, forcing a painful strategic rethink. A trade war would also tarnish Switzerland's carefully cultivated brand as a neutral, reliable hub for global finance, an invaluable hard-won asset. A leading proposal is emerging: a partial transparency deal. It's a delicate diplomatic dance. The U.S. would relax its stringent demands for full gold origin certification. In return, Byrne would grant American authorities limited, regulated access to specific financial data. This helps track illicit flows without dismantling Switzerland's famous banking secrecy laws. Supporters say this compromise could trim the trade gap by $4.5 billion annually, easing premiums and calming the political storm. However, the new compliance mechanisms aren't free. Critics point to the fine print, estimating these new reporting costs could add a lasting $2.3 markup per ounce of Swiss gold, a cost ultimately passed on to consumers. But this conflict raises a profound question for Switzerland. Has its centuries-old policy of staunch independence, once its greatest strength, become a strategic liability in today's era of hardball trade? In a world of large trading blocs, this dispute is a test case, forcing a national conversation about Switzerland's place in a changing world. Meanwhile, financial markets are treating the negotiations like a high-stakes poker game. Traders and algorithms are hyper-alert, with every leak from the closed-door talk sending immediate shockwaves through gold prices. Billions are being wagered on the outcome, with prices fluctuating within minutes. Ultimately, while Washington holds immense leverage, Byrne still holds the gold card, its indispensable role in the physical gold market. A quick U.S. win might feel like a victory, but it could come at a steep long-term price, alienating a critical financial partner and encouraging others to seek alternatives to the U.S. financial system. What began as a tax dispute has escalated into a high-stakes global power contest. This is no longer just about import duties, it's a geopolitical chess match. The U.S. is wielding its economic might to enforce financial transparency, while Switzerland defends its banking secrecy and its dominance in the global gold market. The administration's unprecedented 39% tariff on Swiss gold has put trade ties, domestic politics, and market stability under the microscope. Transatlantic trade is strained, a fierce debate rages in Washington between pragmatists and hardliners, and the gold market, normally a symbol of stability, has become a source of global uncertainty. Three distinct paths remain, each with profound implications. First, compromise. Loosen transparency rules for cheaper gold. This pragmatic route would calm markets and repair diplomatic ties, but critics warn it would undermine U.S. principles and project weakness, inviting future challenges. Second, hold firm. Absorb the costs to uphold the principle of tax compliance. This projects strength but comes with a hefty price tag, forcing the Treasury to pay a premium for gold and risking political blowback from the budgetary strain. Or third, the radical pivot. Diversify reserves into other metals like platinum or palladium. This sidesteps the conflict but is a monumental gamble. These smaller, more volatile markets lack gold's historic status as a safe haven asset, and a large U.S. move could shatter them. The outcome will shape bond yields, currency flows, and the world's view of U.S. fiscal discipline. A compromise could signal weakness. Holding firm could rattle investors, and a pivot away from gold could rewrite the rules of international finance. Each decision carries the weight of defining America's economic leadership for a generation. What do you think? Should Washington compromise to secure Swiss bullion? Does Switzerland's refining supremacy guarantee its leverage? And how might this dispute reshape trade in the next year? Share your thoughts below, and don't forget to subscribe to Geoscope and hit the bell so you don't miss our next deep dive into how markets and politics intersect. Thanks for watching. See you next time.